Global bond markets were flashing amber last week, and should things not improve, there is the prospect of flicking to a deep red. As we head into week 5 of the Iran war in more hope than expectation, here's the lowdown on what to expect in this next report. Take a look.
President Trump's recent efforts to calm markets were nothing more than a flop, as Iran countered with their own requirements and conditions for an end to hostilities. The Strait of Hormuz is the real battle of contention right now, as it's a pain point that Iran knows it can hurt the US with. There has been a re-elevation in inflation break-evens alongside oil. Bond markets are pointing to US inflation approaching 4% in the coming quarters from 2.5% currently. Fed interest rate cut expectations have evaporated. If anything, the market now attaches a greater probability to a hike than a cut as the next move. Global stock markets have morphed to a clearer risk-off phase despite a pullback briefly. The US yield curve has squeezed flatter and higher, and the bets ahead are for even higher yields. A whole series of bond rates are pointing resolutely to a troubling direction. Those expectations are for at least until the war sees a material positive change in sentiment. The market environment craves a positive delta. Even a clear sign that things are getting less worse would be a good starting point. There is a huge relief trade to be had here, on a path switch to a quicker resolution in the war. But until then, the risk remains for a large lurch in a bad direction. The other most important question currently is, can anything stop the central banks from hiking rates in April? Financial markets increasingly say no. Investors are pricing a 60 to 70% probability of ECB and Bank of England hikes next month. The other question here is, what will sway central banks one way or the other, data or energy? ECB President Lagarde said officials want to keep an open mind and let the numbers do the talking. But none of the economic data released over the next month will have much bearing on whether the central banks hike rates in April. The fundamental unknown is not whether inflation will rise in the aftermath of the West Asia crisis, but whether we will see the so-called second round effects. Will we see businesses across the economy raising prices in response to higher energy costs? And will workers demand higher pay as their bills rise? Clearly, the higher energy prices rise, and the longer they stay high, the greater the risk of that happening. Some policymakers argue rates should rise because that's what you do in energy price shocks. Others argue that the economy looks wildly different to how it did in 2022 when the last energy shock hit. Rate hikes rely on energy prices rising faster or the conflict lasting longer. That seems a more likely scenario based on the back and forth between the US and Iran on the ceasefire demands list. Business Bureau WION, World is One.